32 years. That's how far back you have to go to find this level of division inside the Federal Reserve. This just happened, and most investors don't realize what it means yet. Here's what's really going on and what you should be thinking about right now. The Fed held rates steady. Sounds calm. It is anything but. The vote triggered the most internal dissents since 1992. Multiple Fed officials pushed back hard, signaling they wanted a rate hike, not a hold. Inflation is sticky. It is not cooperating. And the Fed's own members are split right down the middle on what comes next. Markets are repricing right now. Rate hike expectations for the rest of 2026 are climbing back onto traders' radar screens. Bond prices are already under pressure. When rates go up, bond prices go down. That's the iron law of fixed income, and it is playing out in real time. Growth stocks are in the crosshairs. Higher rates compress valuations on future earnings, and that hits tech and high multiple names the hardest. Real estate, rate sensitive, full stop. REITs and home builders are feeling the heat as borrowing costs threaten to climb higher. But here's what nobody is saying about this yet. The real story isn't whether the Fed hikes. It's what 32 years of precedent tells us about what happens after a deeply divided Fed finally moves. Historically, when internal dissent runs this high, the central bank tends to overcorrect, either staying too tight for too long or pivoting sharply when something breaks. Both outcomes carry serious consequences for portfolios positioned for a soft landing. The market is pricing in a coin flip. The Fed's own members can't agree. That is not a stable equilibrium. 3 things worth thinking about right now. Educational perspective only. 32 years of Fed history is flashing a warning signal. What do you think this means for your portfolio? Drop it below. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.